The good news is, following the pre-budget report, is that there are many things that we can still do. And one of them that we've talked about before is what we call the Plain Vanilla EBT. EBTs have been in the news because there's been court cases, two I mentioned there, Dextra and Sempre Metals. And in those court cases, the revenue won some points and they lost some points. And so we have a situation now where based on the case law, we can look at how we can use EBTs. What is the difficulty with EBTs? Well, the difficulty is claiming a corporation tax deduction for the contribution to the company. And so in our plain vanilla EBT, we don't. We propose you don't. But what you can do, it is a mechanism for extracting funds from a company without paying the usual tax in terms of either PAYE and NIC or tax on dividends, which, as you saw earlier, is going up to 36.111% of the net dividend. And so how do we do this? What is an EBT? Well, it's an employee benefit trust, and what it is, it's a trust which is set up for the purposes of benefiting either current or future employees, their families, their future children, etc. And once that trust is set up, the company will make a contribution into that EBT, into the trust. Now, as I said, on our scheme, we don't claim on this arrangement a corporation tax deduction. We advise not to, because that is what the revenue will attack. But once that money is in there, it can be used for a number of purposes. You could set up the EBT, the trust, offshore, and just use it as a personal investment vehicle. So those monies are outside of the company. They're in the trust. They sit there. You can invest in either UK or offshore investments. If it's offshore, any gains you make will not be chargeable to tax while they remain in the EBT. Any income on non-UK source monies will not be chargeable to income tax either while it's in the EBT. So that's one possibility, and we do have clients who have done these things and are setting up just their personal investment funds offshore. The other advantage is a 40% tax advantage, because while the monies are in the EBT, they are not in the company, and if you extracted them into your own hands, they would fall into your estate, while extracting them into the EBT and use it as an investment fund means that they are not within the inheritance tax net. So you save 40% inheritance tax on that. The second way of using it is that the EBT, as it's set up, one of the things it can do is it can make loans. And it can make loans to employees because it's for their benefit. Employees include directors, and if those directors are also shareholders, that's okay as well. So shareholder directors can request the trustees of the EBT to make loans to them. Now, those loans, if they are not interest-bearing loans, then there will be a benefit in kind. But if interest is charged at the official rate, which is currently only 3.75%, then those loans, there will be no benefit in kind. The money that you pay, the interest you pay, will go back into that EBT and could be reloaned later. And that situation can roll up. You can keep paying interest, make a further loan later, and the loan could stay there until death, in which case it'll all unravel. And again, you've got the inheritance tax advantage at 40% on death, and you've got a situation where the executors or the family could request EBTs to write off the loan. And that's because the employee has now died, there's no PAYE NIC on that write-off. And so they're very advantageous. And the good news is the government know about all this, but they seem satisfied to have just stopped with disallowing the corporation tax. They haven't attacked the loans, although it would be very difficult to do that. And they haven't attacked them in any way. In fact, the pre-budget report is silent. All the anti-avoidance legislation in there doesn't refer to EBTs whatsoever. So this is something we can do. It's a method of extracting monies out of the company. And if, in fact, in your company you have, let's say the company's made a gain on sale of shares in another company, then that gain is probably tax-free to the company, because there is something called substantial shareholding relief, where if a company owns at least 10% of the share capital of another company and then sells that share capital, that gain is tax-free. So if you are in that position, you're not worried about corporation tax deduction because you're not paying any on the gain. And this is a method of extracting those funds from that gain out of the company without paying that extra 36.111% tax, as it will be, or 25% if you were to do it now. So again, there are a number of ways which we can use this, and the good news is that, as I say, the government have not moved against it. Following the Dexter and Semper cases, they've won certain points and they seem to be sticking there.